Welcome to ForexTV.com. Today is Wednesday, January 7th. I'm Kathleen Reddington with your New York Forex Market Buzz. The dollar falls to the majors on a poor economic outlook. And now for a look at the latest headlines from the CEP News Desk. Producer price inflation in the Eurozone slowed below expectations in November. Eurozone PPI surprised to the downside in the month, coming in at 3.3% in the 12 months to November, down from both the 4.4% rate expected and October's 6.3% print. Excluding energy cost increases, price inflation came to 2.3% year over year. The ADP private employment report indicated that nearly 700,000 Americans lost their jobs in December, a much deeper loss than expected, suggesting that forecasts for 500,000 job losses in Friday's official statistics may be an understatement. The United States is on track to post a $1.2 trillion deficit in 2009, the largest recorded since World War II. The CBO said the deficit would amount to 8.3% of U.S. gross domestic product and that an enactment of an economic stimulus package would only add to the deficit. The CBO also forecasts a rise in unemployment to 9% in early 2009 and a 2.2% decline in GDP. Today we are joined by David Watt of RBC Capital Markets. Hi David, how are you today?
I'm good, how are you?
All right, so it's really not big news that the U.S. economy is in trouble. Everybody pretty much seems to know that. But the Eurozone economy, the Japanese economy, and the British economy are also not doing well. So why are we seeing the dollar fall to them today?
Well, to an extent, the Japanese yen and the British pound, the stories of those two economies have pretty much been talked about for quite some time. It's been known for a long time that the UK economy has been struggling, and that's why Gordon Brown has been talking about stimulus measures, and Chancellor Darling has been talking about stimulus measures. It's been the Eurozone which has been the one that's more recently to the game. And, recent news there was very bad for the Eurozone economy, like the PPI numbers you mentioned today, but the inflation numbers earlier this week and the manufacturing numbers clearly opened the door to the ECB to cut rates, and that had helped give the US dollar a bit of a boost earlier this week. But there really doesn't seem to be a lot of sentiment to want to push the U.S. dollar higher, and then the ADP employment numbers today basically just undercut any sentiment that was bullish towards the U.S. dollar. And, yes, there is clear evidence that the U.S. economy is slowing down, and people have been expecting a U.S. slowdown, but they're not expecting a job loss, a truly abysmal jobs number on Friday, even though I'd say even 500K is probably pretty abysmal, but I think people were pretty comfortable with the idea that, yes, the U.S. economy is going to lose jobs, but if we start getting the idea that there's going to be massive job losses and more spillover into 2009, that does upset the case for being just merely bearish on the U.S. economy to being that this downturn could extend further than we had thought.
All right, and what's your strategy for the dollar then going forward?
Well, it still is going to depend partly on how the U.S. economy shakes out. Like we will have now another reassessment of the U.S. economic outlook, but as you have indicated, that it is already fairly bearish. I think most of it is still going to be on what happens with the euro and the ECB. Like we do have the ECB up next week, trying to decide how much they will cut interest rates and what their outlook is going to be going forward. So that still leaves that environment where there's still uncertainty over how the ECB is going to deal with the downturn in the Eurozone, whereas we know how the Bank of Japan, we know how the Bank of England, and we know how the Federal Reserve, and for that matter, we know how the Swiss National Bank are dealing with their slowdowns. So that still creates an environment of uncertainty for the euro, and as a result of that leaves some underlying support for the U.S. dollar. But again, it's by default as opposed to being optimistic about the U.S. Economic rebound.
All right, now the BOE is expected to cut their rates. What do you think it's going to be, 50 basis points or 100 basis points? Because there's a lot of speculation going on around both. And how do you predict the market will react?
We're in the 100 basis point camp, largely because the credit condition survey, the Q4 credit condition survey that came out late last week, was just atrocious. It indicated that credit conditions are tightening, and that despite the Bank of England and the Chancellor and the Treasury's efforts, it looks like the credit conditions are going to continue to tighten, and credit is going to continue to be increasingly hard to come by. I think the reaction is going to be more dependent on what the Bank of England says and any measures that they come up with in conjunction with the Treasury in order to try and kickstart lending. Obviously, the Fed's already sort of indicated they're going to go into quantitative easing, so we'll be watching for similar moves coming out of the Bank of England from the perspective, and the Treasury from the perspective that they're going to do literally everything they can to make sure that the downturn is as short as possible. And to an extent, that is already sort of being reflected in the British pound, why it's rallying versus the euro at the present time. So we'll be waiting to see if that sentiment is basically stoked, or whether or not there's disappointment with what the Bank of England does.
So what is your sterling strategy then ahead of these cuts?
Well, I think the rally is going to run out of steam, simply because we've had a large correction against the euro, and now the speculation is going to turn over from what the Bank of England has done to speculation about the eurozone will do. And I think we're going to get more news that the UK economy is literally still in a sharp slowdown. So we've had a big correction. It's gone from testing parity against the euro now basically to 90 cents. I think that's a fair level to sort of be at right now, given the what we expect to happen tomorrow and what we think might happen with the ECB in the next week. But again, the risk and the volatility in the situation is extremely high at the present time.
All right, David, thanks for being on the show today.
All right, you're welcome.
This has been your New York Forex Market Buzz with David Watt of RBC Capital Markets. I'm Kathleen Reddington. Join us later this afternoon, 4 p.m. exchange, right here on ForexTV.com.